What's up, everyone? It's Friday and we are live, and it is an absolutely gorgeous Friday today. Today's Sit Down with Sam is a market update, just Sam, and you can see the big smile on my face there as I play a little Billy Idol in the beginning. Just coincidentally happens to be on the radio, which I thought I would take from my mobile location here, but appropriate though for the intro, don't you think, since I'm the only one dancing here, at least in this screen in this party. But want to give you a quick market update and talk about what's going on out there. Been an interesting week. For the first time in a while, we saw interest rates dip back down for a bit, and this was about a 0.25% drop, which was more than welcome. Congratulations to a lot of our clients who were able to take advantage of that when that took place. Gone under contract. It was a nice surprise, and basically what's been going on is that there was the first sign that we may have reached the peak of inflation. So for those of you who have been watching or who may watch the media or some of my other posts, you've probably seen that the Feds have been increasing interest rates to look to push back on inflation and to look to try and create a situation, basically make borrowing money less attractive so people save more, which then in fact will put us in a position where interest rates or where inflation will come down because the supply chain can catch up and prices will come down based off that demand. So when we saw that peak, that starts to show that maybe we could pull back a little bit. Now, that didn't last long. Today start creeping back up, and who knows, maybe we could go further, but it's an interesting pattern to watch. This week there was a lot of people were basically headed for safer ground, if you will, pulling their money out of the markets and putting them back into mortgage-backed securities. So going through and that puts that pressure and allows interest rates a little bit of relief. So welcome relief, we'll take it. You're starting to see a lot of articles pop up about the slowdown in the market and what's going on, and are we going to see a bubble, which a lot of people obviously have talked about how this isn't a bubble, and I agree. But has the increase in interest rates been the signal and the start of what might become a balanced market? Let's call it a more balanced market. I think it could be argued both ways. So a couple things to consider. One, currently right now, interest rates have climbed up, which does unfortunately put a big damper on affordability. In general, right now, houses are about to hit an all-time high of being unaffordable as far as the gap of the price on a property and current wages, which is obviously terrible situation. But going through and looking at this, supply and demand has been a real big driving factor in our market. Well, we are starting to see an increase of the available listings, meaning larger supply. So that's a good sign if that's what you're looking for, but at the same time, it's still such a drastic difference between the demand of people who are looking for housing and the amount of available housing. But this could be a signal that things are starting to pull back, and there's a lot of very well-educated people who feel that the increase in interest rates is going to continue to apply that pressure. We're going to continue to push to where people will again start to save and pull back from making that move, and maybe we'll see the supply chain catch up a little bit. But affordability, rates have gone up, but also across the board, income has gone up. And the increase on average for someone, as for a lot of people, has been 6% or more in their wages. In the private sector, over 9%. I've said this before, but the reality is that the increase in earnings is greater than the cost of home ownership, at least from a perspective of how much that monthly payment goes up. So as you think of that from a perspective, if someone's making $10,000 more a year and their mortgage is only going to cost them $5,000 more a year, then they can shoulder that expense if it's something they're really looking to do. It doesn't mean it doesn't put a damper on the overall motivation from there, but we'll see how that reflects. But do we see the market slowing down? I don't think so. It's still been incredibly busy. We've been taking a lot of contracts in. People are still having a lot of difficulty avoiding multiple offer scenarios, although reports have shown that the requests for showings has dropped down and that the multiple offer scenario may be pulling back. We'll watch that and I'll keep you posted on what's going on. But as for now, Interest rates are still up in that mid to upper 5% range. We saw that pull back a little bit. We'll see what happens next week. Housing stats, this could be one, if anything, maybe if things don't slow down, maybe this will put us in a position where the price of housing starts to taper off a little bit, but that's far from a bubble, in which case you would see pricing drop. I do think in some marketplaces where we saw severe appreciation that we're going to start to see those prices come down. They already have. Listing prices, I think it was 19% is the current factor of the homes that are starting to drop their price. Now, that doesn't necessarily mean that anything other than maybe they were overpriced in the first place. And the way that I would put this, there's a difference in the market in the fact of what someone should pay versus what they will pay. And to just try to shed some light on that, okay? Because my brain's weird, it works weird, and sometimes I need to explain these things. But when I think about what someone should pay, or when you're thinking about that factor, that's referring to people who are buying a property that is supported, the price is supported by the data, the comps, what's going on in the market. Now, when you look at the price of some properties, you would say no one should pay that amount. There's nothing supporting that value. But on the flip side of that, you have what people will pay. And in certain markets, Arizona, just out of hand in the Phoenix area and Scottsdale in those areas, it's out of hand what people will pay versus what they should pay, because you're in a position where you're watching properties still sell at an incredibly fast pace and at an incredibly high price. So when will that balance out? I don't know, but we'll keep our eyes on that, and I'll keep you posted. But I hope everyone's going to have a great weekend. Look for further updates. Take care.